Well, certainly, look, I think that there's lots of headlines around office, and clearly there's lots of banks with lots of office loans, and certainly that's going to have to play out over time. But for open-air retail, I think it's important to make the distinction here. Open-air retail is not office. I mean, despite concerns about a weakening macro, consumer, and tenant credit, open-air portfolios are full. Demand is strong. Leases are getting signed at higher rates, and their balance sheets are liquid. Their dividends are well covered. So we think the sector is a net winner in the hybrid work-from-home world here.
Okay, sure. All right, let's pivot and talk a little bit more about that, because it was interesting to hear Munger call out some of the retail names, and I've heard more concerns after Bed Bath's bankruptcy about who could fill some of these leases. What would you say about Brixmor and their exposures there?
Absolutely. Look, I think stepping back, these tenant issues have been known for some time. Party City, Regal, Bed Bath, it's not new news. And so coming into the year, Brixmor and its peers have budgeted in their full year guidance ranges for potential adverse outcomes. But what we're seeing so far, it's actually notable that there is strong demand for these boxes. You're getting demand from quality tenants like TJX and others. And even more interesting is that the rents here, the mark-to-markets are 20 to 25% higher. So good demand for the boxes. The rents are at meaningfully higher levels. So we think that despite some short-term disruption, maybe some negative headlines, that this is a longer-term opportunity for open-air shopping centers like Brixmor, like PECO, especially those who are more defensive. And I think that matters, too, because within our retail coverage, we favor names that are more defensive, have greater grocer exposure, more necessity-based tenants, stronger balance sheets. And so Brixmor is our top pick this year, and we think Brixmor, along with PECO, are well-positioned because of their positioning with the necessity-based retailers that I played out.
Sure, and Brixmor is only down 6% year-to-date despite those Bed Bath exposures. You like it. You like PECO or Phillips Edison, as we've been discussing. Why do you think and what should we be listening for looking in the earnings, listening for on the call to be sure that their trajectory is still intact?
Sure. I think leasing demand is certainly something that's going to be front and center. It's something that's not new. The landlords have been talking about this for the past year and a half. You would have thought by now you would start seeing some cracks in the armor, some weakness, but the demand remains strong. And more importantly, look, I think it's important to realize that these portfolios are full. The tenant credit has been upgraded post-COVID. There's a lot of weaker tenants that were purged. There's been effectively no new supply here in open-air retail over the past decade, and there's high tenant retention. So when you put that all together, I think it creates a really good formula for landlords to continue to be able to push rent and for their portfolios to continue to perform and for them to raise dividends and to perform in line in terms of earnings. So we expect Brixmor and PECO to raise guidance this week, as their peers did last week, with the tailwinds that we outlined before.
All right, then quickly and finally, when we look at the landscape, where are your concerns mostly centered? For instance, when we talked with Huntington Bank a couple of weeks ago, he said, in terms of exposures, we're actually a little concerned about healthcare, long-term care, where the reimbursements rates haven't kept up with inflation. So is there anything like that, pockets of weakness that you might want to mention that aren't really being talked about?
I think that starting first with the most obvious, obviously the malls are not open-air retail, and their concerns have been publicized for some years now. And so I think that's certainly something we're keeping an eye on. Office, as you outlined. There's a lot of supply in multifamily that's coming into the Sun Belt in the back half of the years, and a lot of levered private operators who've built assets here in a world where cost of capital was different, asset values were different. So I think those going to result in some disruption, potential opportunistic investment. So that's something we're keeping an eye on, because the Sun Belt has been on a great growth trajectory the last couple of years, but that's now stalling at the wrong time because the supply is entering the market in a big way in multifamily. So that's something to keep an eye out on. I'm not a healthcare expert, so I'll defer to someone else to speak to that. But again, malls, office, and then watch multifamily in the back half of the year in the Sun Belt.
Interesting. Malls, office, keep an eye on multifamily as well. It's good to know where you're focused. Handel, thanks for your time and for joining us today.